When Mr. Buffett started investments, he had about 9,800 US dollars. And the whole problem then was he had way more ideas than money. He is looking for products while going through all of Moody's manuals and digging up ideas and stocks of all kinds of items that were cheap. But he still only had $9,800. This is his principle before buying things. For example, he would buy a product that was cheaper and then he found something that looked even cheaper or better. He would have to sell the first product to buy the second item. That was his state of mind for a long time. Now, in the late 1960s, he wound up in a partnership because he couldn't find things to sell. And that's because the whole market had gone crazy at that time. He was working with about $100 million with partnerships when he wound up that partnership. But the $100 million wasn't really an unmanageable amount of money. It's just that the market itself was just offering nothing. But the most important thing to learn is how to value a business. It's also the toughest to explain. You look for certain things that allow you to narrow it down. If he is a basketball coach, for example, when he sees a guy walking on the campus and he sees somebody 7 feet tall, he is interested. In application to the investment, he is looking for things, signals that tell him about details and potentials, what height in particular, and a few things that might tell him if he was a basketball coach. In the end, what he is going to buy is the business, where he feels extremely certain about the competitive advantage, extremely certain about the integrity and ability of the management, and where he thinks the discounted flow of the cash that the business will produce over time makes sense in relation to its current price. You really are looking for a business where you see the future, and that's why we don't get into much tech. 70% of the value worldwide of razors and blades is Gillette. That's after almost 100 years of shaving, and everybody knows what a razor blade does. They all know how to buy good quality blades to be used, and they all know how to sell these through Walmart or any good kind of market. That is 70% of the world. Now, part of that is because men don't like to change when they get satisfied with the product. Men don't fool around with a lot. Women are a little more inclined to experiment. 70% of the world, just think of that. Look at Coca-Cola. 19 billion cases of Coke products are sold per year. You know, everybody in the world drinks it. That changed dramatically in the next 10 years. Let's also look at See's Candy in California. There are 35 million people in California and they have something in their mind about See's Candy. What candies are in your mind, for example? What is the number one candy bar for you? Snickers was the number one candy bar 10 years ago. Question is, was Snickers the number one candy bar 20 years ago? People don't fool around with candy bars. You cannot come out with lots of new bars and intrigue people. It's not like perfume or other things maybe where people love to experiment. There is no good way to compete with Snickers. You want something where price competition is not solely going to be the determining factor. That's true of razor blades. It is also true for Snickers. We can say that it is also true for See's Candy. We can also count it true for Coca-Cola, and there are a lot of things of which it isn't true. That mode is a differentiation of products, differentiation of service, differentiation of location, and that is very essential. When Mr. Warren Buffett was still in school, he'd go back and read papers from all the earlier panics and booms and so on. It's just people make the same mistakes over and over again and they're enormously subject to a herd instinct and they will go crazy. It helps in going crazy to have some sort of excuse that sounds like it's different from this time. But the truth is, if he had gotten $10 in his pocket that he received as a dividend from a business, it doesn't make any difference whether that came from Wrigley's chewing gum or from an internet company. The money spends the same. So the test of a business is not whether it does something glamorous or something new. It's how much cash it is going to produce over time. Investing is laying out money to get more money later on. If he lays out some money otherwise and the money doesn't know where it comes from, may determine something about the enduring competitive advantage and all that sort of thing. But money made from an internet company is no different from money made by a textile company or from a candy company or anything else. Anything new? Maybe it was uranium in the 1950s. Maybe it was computer leasing in the late 60s. All kinds of things come along where rising prices coincide with glamour, and after a point, the rising prices themselves become the rationale for buying. People may dress up in other forms in their minds a little more respectable intellectually, but what they're actually really doing is that they're just getting excited. Greed and fear are the big things in markets, and you will see them in your lifetime. Greed and fear at different points equal anything you've seen in the past. The human race does not get smarter in that respect. You will get a chance to profit from others' folly in a huge way, and the trick is to profit from it, not participate in it. The proper temperament is far more important in successful investing than points of intellect. If you've got a reasonable intellect and the right temperament, you will get very rich. In financial markets, the improbable happens far more often than people think by running statistical progressions. That's why stocks frequently have a high that's twice below in a given year when everybody knows a business doesn't change in value like that except under unusual circumstances. The biggest investment mistakes have been mistakes of omission rather than commission. You see, in your balance sheet or in our income statement, the mistakes that result from the commission. But accounting does not pick up the mistakes of omission, and they are the huge ones, actually. For one story, he met Bill Gates on July 5, 1991. He spent long hours explaining Microsoft to him. He knew he was a terrific guy, a great manager, and Microsoft was awesome, so he bought 100 shares just to keep track of it, but he didn't know enough to make the decision. He really did not know what other people were doing in the field, so it was outside of what he calls his circle of confidence. The important thing in investing is not how big your circle is. It is knowing where the perimeter is so that you stay within the circle. That costs billions of dollars and never shows up in our financial statements. The mistake that you can see is Berkshire Hathaway today is a merger of 3 companies in his business life. There was the original Berkshire Hathaway, which we bought into in 1965. Then there were 2 other companies. All 3 of those were mistakes, starting with the textile business. Berkshire was a textile company with a 20 million net worth. The whole 20 million was tied up in the textile business, and it was a lousy one. He bought it because it was cheap and not because it was good. He learned from a fellow who was a magnificent teacher and did all kinds of things for him about the emphasis on buying things that were quantitatively cheap. That was the background from the 30s and 40s. It was the wrong kind of business to buy. It had actually lost significant money over the previous 10 years, but it was very cheap. It was a terrible base to build and what has become of Berkshire Hathaway. Those 3 were mistakes, but we did go into these other businesses. He learned after a point that the real thing in business is to be in good businesses with good people, and that's what works. As the years have gone by and the capital he has been working with has increased, there are fewer opportunities, so he never has to sell anything now to raise money to buy something else. It didn't just happen that way. Now he got more money than ideas, and it will probably stay that way. When you are in a position with relatively little capital, you sell something that offers you more for your money. Or, if you're really sure about it, then go for it. But if you're in his position, you basically don't sell. Generally speaking, if you've got a lot of capital, you're not going to find that many wonderful ideas. And if you look at the fortunes that are made in this country, generally they have been by owning a good business for a long period of time. A number of them might have danced around and Berkshire was too high at a certain times. They might have tried to sell it and buy it back, but usually that doesn't work very well. So, if you lose confidence in the management or the business, you sell. No sense in owning something where the competitive advantage is gone, or where you think the management is bad news. You may wish to sell if the price is too high. Remember again, the important thing in investing is not how big your circle is. It's knowing where the perimeter is so that you stay within the circle.